Welcome back friends, for one more update from the world of high growth EV stocks. In case you are new to this channel, please do consider subscribing. Now let us get right into it. If we look at the technical charts of NIO again, we see that NIO has crashed from a high of $64.60 on 10th of February 2021, down to an intraday low of $31.91 on March 6th. This was a total crash of a little more than 50%, in just 17 trading sessions. Needless to say, this has been a savage crash, and many of the NIO investors simply got scared, and paper-handed their NIO shares along the crash. We of course have always maintained the view on this channel, that the NIO stock must not be sold now, as this current crash has almost nothing to do with NIO in specific, and it is just a temporary correction in the broader markets which is bringing down all high growth or tech stocks. The 10-year Treasury bond yield is rising, indicating that the bond traders are expecting an inflationary pressure on the US economy very soon, and that has been in turn causing this massive downward pressure on the high growth stocks. We did finally get some relief rally towards the latter half of trade on Friday, and NIO actually bounced back from the intraday low of $31.91 to close above $38. That has made everyone wondering if the crash is now finally over, and if a bottom was already made on Friday. Honestly, no one truly has an answer yet to the question, but there are certain key numbers we may want to keep an eye on to gauge what might happen next week. A key indicator of the inflationary risks is the price of crude oil. If the crude oil price keeps rising, that will entice the bond traders to again dump their treasury bonds next week, causing the yield on these treasury bonds to go up again. And if that happens, we are again in troubled waters.
But I'm not the one who controls the bond market. I keep telling you this moment feels like the period from November 2015 to February 2016, when our old Fed chief, Janet Yellen, looked at the dashboard of the economy, very similar to right now, saw some inflation indicators flashing red like we have right now, and decided it was time to raise rates. Even though she appeased the bond vigilantes and gave a sample warning, the economy was crushed and stocks took a hit. And that's what I fear. I fear a repeat of that time. And I am staying not as a vigilante, but I'm staying vigilant. Powell refuses to be cowed, but the bond bullies, who are very powerful, don't believe it. The Fed's had a zero-tolerance policy toward inflation for my whole career. These guys can't imagine suddenly there's this guy Powell who would chart a new course, no matter how many times he explains it. Now, the session opened rocky because lots of investors bought stocks with borrowed money over the last few weeks. Margins nearing a record high here. And they got blown out by this week's decline and a sharp initial move up in rates in reaction to that employment number. But then rates reversed, and we got one of those whoosh bottoms I've been telling you about, where we have a sharp decline fueled by forced selling, and then the market swiftly rebounds when that selling is over, if the bonds rally and interest rates fall, and that's what happened. So are we out of the woods? No, that's just one day's worth of a scenario, not so fast. The battle is far from over, with lots more collateral damage, particularly, by the way, I don't know if you noticed, but the highest growth stocks, even today, and the myriad SPACs, they're still being taken out and shot despite the nice backdrop. Basically, everything that was red hot a month or two ago is not so great. So here's how I see it playing out. Whenever we get good news for the economy, like when the Senate passes a stimulus package, or when we get big vaccine benchmarks, the bond vigilantes will come out of the woodwork with the same playbook that you saw earlier this week. They will dump bonds, pushing long-term interest rates higher and triggering more weakness in the stock market like we saw yesterday. The only thing that will stop the bond bullies is weaker economic data, especially lower commodity prices like oil, copper, lumber, plastic, and paper. That hasn't happened yet, but if you got those lower, then the heat's off Powell. But we're not there yet, so expect more of what's happened in the last 2 days.
So, as Jim Cramer thinks, we also believe that it's still premature to assume that the pain is over for high growth stocks such as NIO, and we might well see a return of selling pressure for NIO next week. But investors need to also remember the true long-term potential of a company like NIO before selling any NIO share in panic. NIO is currently the best placed EV company in China for many more years to come. From the latest quarterly reports, we learned that NIO is currently sitting on a cash position of $6.5 billion. Which means NIO will also not see any cash burn related risks anytime in the near future. NIO's revenue has been growing very strong quarter on quarter, and after having had their best quarter in history in Q4 of 2020, they are expecting to do even better in the Q1 of 2021. Things are looking only positive for NIO, no matter in which way we try to analyze the company. And the Chinese government is moving really fast, making the country switch from internal combustion engine cars to electric. We see NIO as being the main company, besides Tesla, which will help the fast-growing Chinese economy make this transition to electric, and we remain extremely bullish on NIO for the medium to long term. As always, thank you for tuning into this update. And if you want to have a broader understanding of why the stock markets are falling these days, please check out the video you now see on your screen.